Respected Wall Street analyst Tom Lee recently went on the CNBC Closing Bell show and stated that the stock market could have a positive case scenario from tariffs, and that it's setting the stage for a much bigger recovery rally than we expect after the recent market sell-off. As you know, I'll play you the CNBC footage of Tom Lee talking about this on the show. After that, I'll give you my own reaction of his take. Going by what Tom Lee is predicting, the next 10 days will make millionaires in 2025. In this video, I'll also give you an in-depth analysis on one super growth stock to buy on the dip, with the potential to make you a millionaire this year. We're talking about a company that's disrupting an entire industry, a leader in the fintech space using technology to revolutionize how we bank, borrow, and invest. They're growing at an insane pace, attracting millions of users, and their stock is primed for a massive breakout. If you only watch one video today, make sure you watch this one all the way till the end, because I'm going to break down exactly why major investors are so bullish on this stock and why it could be your ticket to life-changing gains. Hit that like button. Let's get 1,000 likes on this one. Share the video and leave your thoughts in the comments, and subscribe so you don't miss out on the next important financial investing update. Today's video is sponsored by my good friends at Forecaster Terminal, the best stocks analysis software I use in finding these incredible stocks. More on that later. Let's hear what Tom Lee has to say.
What do you make of this report? I mean, part of the uncertainty of all of this has been the, iron fist, maybe olive branch. Back to the iron fist, maybe an olive branch. What do you make of it?
Well, I think markets should interpret it positively, because I think when we talk to our clients, many are viewing tariffs as punitive, potentially protectionist, and driving several economies into recession. This sounds like that we could actually have a positive case scenario with these tariffs, one that's either mutually agreed upon or if it's reciprocal, but maybe a good deal for businesses. And I think it would set the stage for a much bigger recovery rally than we expect. Afterwards, right?
Yes,
after.
The problem is the paralysis, if you will, between now and then. Like, what are we supposed to do over the next 10 days?
That's the dilemma, right? Because we still have 8 trading days till April 2nd. Most investors are getting just nauseous from the volatility. So they want to throw in the towel. But we also know that markets will bottom, or have historically bottomed, before the event actually happens. The best example is the Cuban Missile Crisis, 1962. That was a 12-day crisis. The stock market bottomed 7 days into that crisis, recovered 2/3 of the losses before the resolution. So I think that's a decent template for today.
What about the economy? I mean, listen to Nike, FedEx, put that on top of what we've already heard. Are you concerned about where the economy's going?
It's been pretty shocking how quickly sentiment deteriorated. I can understand for consumers because the president's very divisive, but for CEOs, that's been a shock. CEO confidence has fallen, and they've kind of been sitting on their hands. So we know there's an impulse of a growth shock underway. But if this is something that doesn't last months, then it's very temporary.
I mean, it depends, to what degree consumers remain skittish. CEOs are paralyzed in their own right because they can't really make any moves because they're not sure what's going to happen, and ultimately whether a growth scare spirals into something else, which Jeffrey Gundlach gave me his view yesterday right here on Closing Bell. Listen.
I do think the chance of recession is higher than most people believe. I actually think it's higher than 50% coming in the next few quarters.
50, 60%? I mean, if he's right, what does that mean for the stock market?
Well,
way too expensive.
Well, the S&P had a 10% drawdown. That's already priced 40% chance of a recession. I'd say the markets aren't agreeing necessarily with his view because China, Europe, Canada, Mexico have been massively outperforming the U.S. since February 18th. Those economies should be tumbling into recession if we have punitive tariffs. So I think markets are actually more paralyzed than necessarily pessimistic. And
I'm sorry, finish your thought.
But because the market is the economy, I think to the extent that stocks rebound sharply after April 2, if they do, I think it really staves off future economic
Is the market
weakness.
the real economy?
I think these days, to me, I think it's a really good snapshot of actual sentiment and actually even CEO decisions. Because as you know, when stocks fall, companies lose confidence. And as stocks recover, CEOs gain confidence.
What about the idea that Gundlach also put forth that in his words, unintended consequences of all of the rhetoric from the president is making people think twice, especially overseas, about investing in the U.S.? and the view that Europe is just a better value and offers even less risk than before. How do you play that?
I mean, we hear a lot of folks talking about that, but as you know, Europe tends to be single stock concentrated indices. So if you're buying Europe, you're basically buying industrials and financials. If you're buying Korea, you're buying Samsung. So I think if someone is looking for the best companies, they're still going to end up buying the U.S. You know, one of the things that we have to keep in mind is this trade deal, if it's acceptable, could actually basically sort of blunt this whole issue of trade in the future, and it would actually make the U.S. more attractive again.
All right, let's break down what Tom Lee actually said and what it means. First off, when he's asked about the market's reaction to tariffs, he takes a pretty optimistic stance. He believes that, contrary to the fear-driven narratives, tariffs could actually lead to a positive outcome, one that's either mutually agreed upon or at least structured in a way that benefits businesses. He's essentially saying that if a deal is reached, we could see a major rally in the markets. Now that's an interesting take because most people tend to focus on the doom and gloom aspect of tariffs rather than the potential for a structured, favorable resolution. Then there's the big question of what to do in the short term, between now and April 2nd. Lee acknowledges that this is where the real problem lies. He describes the market as being in a state of paralysis, with investors getting nauseous from all the volatility. And I mean, who can blame them? But his point is that historically, markets tend to bottom out before the actual resolution of a crisis. He even references the Cuban Missile Crisis in 1962, pointing out that the stock market bottomed out 7 days into that crisis long before an actual resolution was reached. That's an important insight because it suggests that waiting for the dust to settle before making moves might not be the best strategy. Now, when asked about the economy, Lee acknowledges that sentiment has taken a serious hit, especially among CEOs. And he makes a great point here. CEO confidence has dropped significantly, which is a bit of a shock because normally, you'd expect that kind of uncertainty from consumers, but not necessarily from corporate leaders. He calls it a growth shock, but also suggests that it could be very temporary, as long as it doesn't drag on for months. The key takeaway here is that uncertainty is what's really causing hesitation in the economy, not necessarily the fundamentals themselves. Then the interviewer references Jeffrey Gundlach's assertion that there's a greater than 50% chance of a recession happening in the next few quarters. Now Lee doesn't fully buy into that. He breaks it down by explaining that if the market had already priced in a 10% drawdown, that would mean investors have already accounted for a 40% chance of recession. But the real kicker in his argument is that other global markets, China, Europe, Canada, Mexico, have actually been outperforming the U.S. since mid-February. If we were heading straight into a recession, you'd expect those economies to be collapsing, but instead they're doing the opposite. So his take is that the market isn't necessarily pessimistic, it's just paralyzed with uncertainty. Now, here's a really interesting point he makes about the market and the real economy. He argues that stock movements are a direct reflection of CEO sentiment. Basically, when stocks fall, companies lose confidence, and when stocks rise, CEOs feel more optimistic and make moves. And that makes a lot of sense when you think about it. If you're running a major corporation, you're looking at stock performance as an indicator of where things are headed. So if we get a sharp rebound after April 2nd, according to Lee, that could actually prevent further economic decline. And then there's the question of global investment. The interviewer brings up the idea that people might be looking at Europe as a better investment option, seeing it as less risky than the US. Lee pushes back on that, making the argument that Europe's stock indices are very sector concentrated. Basically, if you're buying into Europe, you're mainly buying industrials and financials, and if you're buying into Korea, you're basically buying Samsung. His point is that if investors are looking for the best companies overall, they're still going to end up choosing the US in the long run. So overall, Tom Lee's view is that while things seem uncertain right now, the market isn't as doomed as some are making it out to be. He's focused on the idea that a deal on tariffs could trigger a rally, that the market typically recovers before crises officially end, and that while CEO sentiment has taken a hit, it could bounce back quickly if stocks recover. He also isn't fully convinced of an impending recession and believes the market is more frozen in place than truly pessimistic. It's an optimistic yet measured take, and honestly, it's refreshing to hear a perspective that isn't just about fear-mongering. What do you guys think? Do you agree with Lee's analysis, or do you think the risks are bigger than he's letting on? Drop your thoughts in the comments, and let's discuss. Alright, let's cut to the chase and talk about the super growth company I'm so fired up about. It's SoFi Technologies, ticker symbol SoFi. Now, if you haven't heard of SoFi yet, you're seriously missing out. They're not just another financial company, they're a complete game changer. Imagine a world where banking is simple, transparent, and actually designed to help you win financially. That's the future SoFi is building. So, what makes SoFi so special? First off, they're taking on the big banks head-on by offering a one-stop shop for all your financial needs. We're talking student loan refinancing, personal loans, mortgages, investing, you name it. SoFi's got you covered, all within one sleek and user-friendly platform. But here's the real kicker. SoFi is leveraging the power of technology to make finance accessible and affordable for everyone. They've ditched the outdated, fee-heavy model of traditional banks and replaced it with a tech-driven approach that puts the customer first. No more hidden fees, no more confusing fine print, just straightforward financial products designed for the modern consumer. And the numbers don't lie. SoFi is experiencing explosive growth, adding millions of new members every quarter. People are flocking to their platform because they're tired of the old way of doing things. They want transparency, they want value, and they want a financial partner that actually has their back. That's what SoFi delivers. Now let's talk about why I'm so bullish on SoFi, even after the recent dip in the stock price. Well, for starters, I see SoFi as a classic case of a disruptive company being temporarily undervalued by the market. The recent banking crisis shook investor confidence in a lot of financial institutions, and SoFi got caught in the crossfire, even though their business model is fundamentally different and far more resilient than traditional banks. I believe this dip is a prime buying opportunity. I see SoFi's strong fundamentals, their rapid growth, their loyal customer base, and their innovative technology as indicators that the company is poised for a massive rebound. Multiple analysts have given SoFi a strong buy rating, with price targets significantly higher than the current stock price. But here's the thing about SoFi that really excites me. They're not just content with disrupting the traditional banking industry, they're also making major moves in the world of investing. SoFi Invest, their online brokerage platform, is already a hit with millions of users, offering commission-free stock and ETF trading, fractional shares, and even access to IPOs. SoFi is democratizing investing, making it easier than ever for everyday people to build wealth through the stock market. And with their recent acquisition of Galileo, a leading financial technology infrastructure company, SoFi is now positioned to become a true powerhouse in the fintech space. They're not just building a better bank, they're building a complete financial ecosystem that empowers their members to take control of their money and achieve their financial goals. I've looked at the numbers, I've followed SoFi's journey, and I truly believe this company has the potential to be a game changer. SoFi is with a market cap of $14.11 billion. The company recently hit a major milestone, reporting GAAP profitability for the first time in 2024, with earnings per share coming in at 46 cents and a price-to-earnings ratio of 27.98. With $2.61 billion in revenue and a net income of nearly $500 million, SoFi is proving that its business model has serious potential. Despite some market downturns, analysts remain optimistic about SoFi's long-term growth. The company has seen a massive 34% year-over-year membership increase, now surpassing 10 million members. This surge is largely driven by SoFi's innovative approach to financial services, making it a go-to platform for younger, digitally savvy consumers. SoFi's revenue growth has been strong, fueled by higher adoption of digital financial products and continued expansion into new areas. However, this rapid growth has come at a cost. Heavy investments in technology, marketing, and customer acquisition have kept profit margins under pressure. While revenue continues to climb, net income improvements have lagged behind due to the company's aggressive reinvestment strategy. Strategic partnerships have played a critical role in SoFi's expansion. The recent launch of the Wyndham Rewards debit card and a $5 billion loan agreement with Blue Owl Capital are just a few of the moves positioning the company for future success. These initiatives not only strengthen SoFi's lending platform, but also broaden its appeal to a wider audience. That said, the company's financial structure reveals some key trade-offs. While SoFi maintains a balanced debt-to-equity ratio, indicating controlled financial risk, its return on equity remains modest compared to traditional financial institutions. This is largely because the company is prioritizing market expansion over short-term profitability. Looking at the bigger picture, SoFi's competitive advantage is rated around 6 out of 10, reflecting its strong brand and technological edge, but also the intense competition it faces in the fintech industry. The absence of an aggressive stock buyback policy suggests management is prioritizing growth over shareholder returns for now. Additionally, the company's revenue remains predominantly domestic, which could present both opportunities and risks as market conditions shift. Overall, SoFi Technologies is a fintech powerhouse with strong fundamentals, but its profitability remains a work in progress. While efficiency improvements make the company resilient, continued monitoring will be crucial as it navigates the evolving financial landscape. Investors should weigh the long-term potential against the current risks, keeping a close eye on how SoFi balances growth with profitability in the years ahead. SoFi is operating in a massive and growing market. They have a first-mover advantage in a rapidly evolving industry, and they're led by a visionary CEO who's not afraid to challenge the status quo. Of course, like any investment, there are risks involved. SoFi is still a relatively young company and their stock can be volatile, especially in the short term, but for long-term investors who are looking for exposure to the future of finance, SoFi presents a compelling opportunity. So, there you have it. Tom Lee's bold prediction, and why this could be your chance to get in early on the next big thing. Remember, this isn't financial advice, just my opinion, and you should always do your own research before making any investment decisions. If you're serious about finding winning stocks in seconds to skyrocket your portfolio, you should use Forecaster Terminal, the ultimate AI stocks analysis tool for uncovering high-value investments. Try it for free today. Just click the link in the description with my code Galore10 for an exclusive 10% discount. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the Stocks Galore Patreon today and take your investing game to the next level. Our members there get full in-depth analysis on most of these stocks I mention here. Head over to patreon.com/stocksgalore and become part of our growing community of smart investors. Link is in the description. And as always, hit that like button, share your thoughts in the comments below, and subscribe to the channel so you don't miss out on the next stock poised for massive gains. Until next time, good luck on your investing journey.